everyone, welcome back again to my channel, and I'm very happy that you joined me again to another learning adventure. And for this vlog, we're going to discuss about financial planning and forecasting. So, what are we waiting for? Let's begin. Financial planning aims to ensure that a firm or business is properly capitalized and makes appropriate investment. So what's about financial planning? So we are going to discuss it here on this vlog. Financial planning aims to ensure that a firm is properly capitalized and makes appropriate investment. There is enough budget, there is enough fund. Financial planning is important in ensuring that corporate investment is financed appropriately, as well as seeing to it that money is spent in worthwhile investments. Achieving the goals of corporate finance requires that any corporate investment be financed appropriately. The sources of financing are capital self-generated by the firm and capital from external sources obtained by issuing a new debt and equity. The financing mix will impact the valuation of the firm as well as the other long-term financial management decision. There are two interrelated considerations here. First, management must identify the optimal mix of financing, the capital structure that results into maximum value. Equity financing is less risky with respect to cash flow commitments, but results in a dilution of share ownership, controls, and earnings. Second is, management must attempt to match the long-term financing mix to the assets being financed as closely as possible in terms of both timing and cash flow. Most organizations prepare a revised forecast for the balance of the year, taking into account earlier budget and forecasts. This step is particularly important if there are variances from the original budget. For example, if sales are less than projected because market conditions are less favorable than anticipated when the budget was prepared or forecasted. Managers may look for ways to increase sales or reduce expenses in order to avoid a loss for the year. Organizations may carry out a form of economic forecasting, which is the process of making predictions about the economy. Forecast can be carried out at a high level of aggregation like domestic gross product or gross domestic product or GDP, inflation, unemployment, or the fiscal deficit. They may also happen at a more disaggregated level for specific sectors of the economy or even a specific business or firm. Some forecasts are produced annually, but many are updated more frequently. There are many other forecasts that managers ask for in order to try and anticipate what the future might hold, and so that they can prepare contingency plans in case of unforeseen events. When you say contingency plan, that's plan A, B down to Z. Example of unforeseen events that may affect future outcomes are the arrival of new competitors, a change in the overall economic outlook which could affect cost and or revenues either positively or negatively, or even the arrival of a new company in another line of business that could raise prevailing wage rates in the region. Managers like to develop forecasts of figures such as sales, costs, cash, profit, interest rate using different assumptions. Another word for forecast is what we call scenarios. For example, let us assume that a forecast of the income statement for a business at the end of the year assumes that sales will grow by 8% over the previous year and cost will grow by 6%. A manager might ask for an alternative scenario where sales increased by 12% and cost increased by 9%, and the other scenario where sales decreased by 3% and cost increased by 1%. I hope you learned something on this vlog. Thank you for joining me and enjoy learning.